So let me begin by telling you a story. It's a story of a woman, Maria. She's 44 years old. She works an informal job as a street vendor, 11 hours a day. She has 3 kids. Maria lives in a one-bedroom dwelling in Los Piletones, one of the most deprived slums in the city of Buenos Aires, Argentina. This woman, with a great effort, occasionally is able to put away some money to save for a dream, for her dream, to build a new bedroom for her pregnant daughter, Juanita, and her unborn baby. She keeps her hard-earned savings in a jar. As you can see, it's not the most efficient method to save. Sometimes she forgets to save. Sometimes she's tempted to use the money to buy things, like a new pair of tennis shoes. Sometimes she's even victim of a robbery. Even worse, I'm from Argentina, Ricardo is from Venezuela. The value of her savings is still every day by a silent thief, inflation. Yet, the story of Maria encapsulates the story of millions of Marias around the developing world that struggle to save and invest for housing improvement and self-construction. Why do these Marias struggle so much? Well, the findings of behavioral economics point out the poor are particularly affected by self-control and inattention biases. Maria forgetting to save, Maria tempted to spend some money for buying things. Yet, these behavioral biases are not the only cause behind these Maria's problems to save. They also lack access, as Ricardo was saying earlier today, to a crucial asset, the financial system. It is roughly estimated that around 2 billion people in developing countries do not have a bank account. Yet, even owning a bank account in developing countries is not a guarantee that you're going to have credit financing, in particular for self-construction, housing, and housing improvement. Why do the Marias of the developing world cannot have access to the financial system and credit financing? Well, the evidence singles out 4 main culprits. The first one is that the Marias of the developing world lack collateral, credit history, and regular income. Secondly, they have some informational barriers. They don't understand the benefits of investing and saving for housing improvement. We have these behavioral biases that I already mentioned. And the most important thing is that this housing deficit that I already mentioned is a very serious issue, serious problem in developing countries. For instance, in my region in Latin America, around a third of the households live in adequate housing conditions. Another 3 million live in houses that are beyond repair. So what can be done? What can be the solution for this? Well, as the Marias of the developing world cannot qualify for a regular housing loan or a mortgage because they lack collateral, credit history, regular incomes, we developed with Eduardo Levi-Cecchati, a Kennedy School faculty at CIPPEC, the principal think tank of Argentina, one of the top 3 in Latin America, an innovative financial product that is targeted to low-income households. La Caja de Ahorro en Ladrillos in Spanish, in English, the BRICS Savings Account, or BSA. What's the BSA? Well, the BSA is a commitment savings account combined with a credit line attached to a predefined goal of housing improvement, like Maria's dream of a new bedroom for her daughter. How this financial instrument operates? Well, it comprises 4 different steps. First of all, the financial institution helps out the client to calculate the cost of the housing improvement dream. Again, like Maria's dream. Secondly, the client signs a commitment letter, which establishes the amount of money and the period of time required to achieve this housing improvement dream. Over the saving period, the financial institution sends text messages with motivational contents, saving strategies, and reminders aiming to address these behavioral biases that I already mentioned, self-control, inattention, etc. And third, if the savings goal is achieved, the bank or the financial institution grants a credit line. And this credit line can only be used for acquiring, buying, purchasing construction materials. And finally, and that's a crucial issue or feature of this product, the credit line can only be used for this acquisition of construction materials by the client through the use of a debit card at the retailer. Okay? Why we are convinced this is going to work? Well, let me give you 4 reasons. First of all, and this is crucial, through the use of mobile banking technology, the clients are going to be able to operate and access the account through his cell phone. So reducing administrative costs for both the client and the financial institution, reducing costs, fixed costs. Secondly, by sending text messages, by the commitment letter, and also by giving this financial incentive, the credit line, the BSA is going to address these behavioral biases related to self-control and inattention. And third, instead of saving in a jar, the clients of the BSA will be able to save and borrow in bricks, fostering financial inclusion and mitigating the housing deficit. And finally, and this is very important, we developed this product as a financially profitable product at market rates. This would generate new revenue and funding sources for the participating financial institutions. It's not a subsidized financial product. So, to remember the story I tell at the beginning of Maria. Well, thanks to the BSA, millions of Marias around the developing world will be able to tap the benefits of the financial system. So please support the BSA. We think it's a very good idea, reduces costs, let these Marias to access the financial system, and also contributes to reduce the housing deficit in Latin America. Thank you very much.
Good morning, I'm Shawn Cole. I'm at the business school, and I teach a class called Business at the Base of the Pyramid. And we have a module there, so it's about selling goods and services to the 3 billion people who earn less than $10 a day. And we have a module on financial services. So I found this as a fascinating example of a new financial service. And I thought also maybe a chance to put the frameworks that we teach the MBAs to a test, right? So I wanted to look at this product through that line. And I think in some sense, there's already some precedents for tremendous success. You're probably familiar with Patrimonio Hoy, which is a program by CEMEX in Mexico, which is providing credit to people who are trying to improve their houses. And they've made $300 million in loans and managed to succeed at that. But if we take a step back, I'm a development economist. We focus on poverty. We have to remember that poverty around the world is plummeting. We're going from something like 30% to 10 or 12% living below the extreme poverty. And that's creating some really interesting opportunities, right? So in the next 20 years, over 1 billion people are going to enter the formal financial system, and in large part because of the declining transactions costs associated with digital financial services. And so it's a really interesting question. How can firms develop innovative financial services, deliver them profitably, and in a manner that improves customers' welfare, right? So we've seen tremendous financial innovation and expansion of mortgages in the past decade in the US, but not many people would say that that was a great success for the world. So when I think about financial services, I think there are 3 things that you have to think about in this market. One is understanding consumer demand. And I think here the proposal excels. He's clearly read all of the academic literature on behavioral biases. And it's not just the poor who have behavioral biases, as anybody who's signed up for the gym and not made the minimum number of trips per month to justify it can attest. So I think he's been careful there. I would say we shouldn't oversell the behavioral literature. I think economists love to take these papers out and say, see, people have self-control problems. But when you read it carefully, for example, the Philippines savings product that was most prominently cited, tremendous paper, I think fewer than 25% of the population takes that up. And the average increase in savings is among the people offered the product is relatively low, 10 or 15%. You talk about using reminders. And the literature on reminders says that reminders do increase savings, but only by 6 percentage points. And if you've got somebody like Maria who's saving $4 a month, 6% more than $4 a month is not a lot of money, right? So make sure it's more than the cost of sending the text messages. I think there's scope for improvement here. I think there's startups like Juntos in South America that are developing sort of artificial intelligence chatbots that kind of interact with the customer and generate a little bit more of a relationship than giving simple reminders. There's IBM's Watson team in China has developed a chatbot that talks regularly with 1 million people. So there might be some interesting new ways to provide advice, getting back to the earlier project. But something else I really like about this is I think we're seeing a lot of the innovation in the financial services space coming from developing countries and sometimes making it to the US. So I've done a lot of work on rainfall insurance, but another example is prize-linked savings accounts, which are coming to the US thanks to pioneering work in emerging markets. And I think that's an interesting case. Another thing I focus a lot in my course is managing external factors, but this doesn't seem like a product that's going to upset anybody. I guess if you're helping squatters build property on that land, then maybe there could be some political issues there, but to first order, it doesn't seem like a major concern. So I would just run through what we teach as our checklist for success. Does the product create value for the customer? And I think absolutely, right? The informal borrowing system is unreliable, incredibly expensive, and often just inaccessible. There's a lot of work that shows that big ticket items are really hard for the poor to buy. So if you buy 1 bag of cement a month, then that gets stolen or you can't build efficiently. Whereas if you can go to the store and buy everything you need, get some help from friends, and do your construction in 1 or 2 days, the cost of construction can be a lot lower. So I see this as potentially creating a lot of value for the customer. I think the customer will understand this product, although I would point out that education is extremely costly. So the plan said we're going to do door-to-door marketing. But in best case scenario, you might get take up of 10% for this product. That means you have to visit 10 households for every person who takes up the product. If it costs $3 to visit each household, because you have to pay the person to visit them and you have to monitor them to make sure they're really doing the visits, then all of a sudden you're spending $30 for each client you sign up, and the economics of the product may become more challenging. So I would try to think about viral marketing or other approaches to promoting adoption. I think the customer is going to want this product. I think they'll see especially that as soon as I get to $50, that unlocks a credit line that doubles my purchasing power. That's going to be an exciting value proposition for the customer. And you do seem to be very cognizant and aware of behavioral biases that might intrude there. I think it's important to think about whether the product itself can create value for the firm. And so you say it will be profitable, and I'm glad to see that. I might say, show me the discounted cash flow or the model to think about this. I think the most successful products in this space, financial services for the poor, often introduce new contract structures. So microcredit has borrowers monitoring each other, or think of new ways to allocate transaction costs. And so the use of digital services, I think, is great. I think one problem with lending is repossession is very costly, but if people are buying some sort of equipment that maybe could be repossessed, then focusing on housing might make sense. I think it's nice that the housing material vendor is bearing some risk because they've got presumably a high margin on the products they're selling, so it's a little bit less costly for them to suffer default if it's expanding their sales than it would be if you were just going through a microcredit agency. So I like that a lot. I think this sounds like something that could raise low-cost impact investing equity or debt, and so that will potentially make it a little bit easier to hit the profitability. I didn't see the APR or the proposed APR in the proposal, but it'd be nice to know what people are paying and what their comparative prices are. So overall, I like the product a lot. I think there's a really good chance that it'll succeed, but I think the real challenge is going to be getting uptake and spreading it around.